Welcome back to Finance News, the only channel you need for all of the best stories in the wacky world of the stock market, business and finance. Coming up this week, we've got everything from Elon Musk to Peloton and the Bank of England to ASOS. So without wasting any more time, let's get straight into the headlines. On Thursday this week, Elon Musk revealed that he'd made a formal offer to buy Twitter. The Tesla boss revealed the news directly through Twitter with his own tweet linking the SEC filing, which stated that he wants to make an all-cash offer for the business of $40 billion, valuing each of the shares worth $54.20. Musk already owns 9% of the business, which was made public last week through public SEC filings, and he was initially offered a seat on the board, which he subsequently declined to take. Instead, Elon, being Elon, decided to buy the company instead, stating in his offer that he believed the platform had huge potential that was not currently being unlocked, and that he was the person to do it by taking the company back into private ownership. Twitter responded by acknowledging the offer, calling it unsolicited, and will be holding a board meeting to discuss it. I've got no idea what happens next because I bet by the moment I finish recording this and editing it, something will probably change, so you'll probably know more than I have right now. Anyway, why not complete the story below in the comment section? Outside of everything Musk, new US inflation data was released this week showing continuing inflation in the world's largest economy remaining anything but transitory. Inflation hit an 8.5% surge in March when compared to the 12 months prior, setting the fastest rate since 1981. The rise was mainly due to the booming gas prices caused by the Russian invasion in Ukraine, which has exacerbated the already strained supply chains. The rises have seen American households put under enormous strain at the pumps, as well as in supermarkets, as energy prices make up a part of almost every essential consumer good, including food. However, the news was not all bad, and there were some glimmers of hope on the horizon. Core inflation, which removes fuel and food, decelerated slightly from February as used car prices finally cooled off. The core measure was 6.5%, up from 6.4% in the year through February, and slowed slightly on a month basis, leading some analysts to believe that we're now through the peak of the current period of high inflation. I love the core inflation measure because humans should really be able to survive without food and fuel, especially if it means a lower percentage number. Jumping now over to one of the darling stocks of the pandemic, Peloton is looking to increase the price of its subscription service to boost its returns after an amazing fall from grace. The stay-at-home exercise bike company that impressed investors during lockdowns has seen its favour decline since the world was able to open back up. Barry McCarthy, the new CEO, formerly of Netflix and Spotify, announced this week that the company is seeking to do a double whammy of changes that will see subscription prices increase whilst also cutting the price of its hardware, which includes both its bikes and more recently its treadmills. McCarthy has stated that he wants to reduce the barrier to entry for new customers and move the company to more of a subscription-based model, which it's trying out for some newer customers who will pay around $60 to $100 to have their hardware and software bundled together. The price changes will mean the bike will drop around $300 from $1,745, and the tread machine will come down in a similar fashion to around $2,695. Bear in mind that is a lot of money for a clothes drying rack, so if you are on the market for something like that, then you can always go outside and pick one up from Wilko instead. Across the pond in Europe, the European Central Bank is getting to grips with keeping inflation under control. The ECB chief Christine Lagarde confirmed that they had held interest rates at its latest meeting on monetary policy this week, as Eurozone inflation had climbed to 7.5% in March, up from 5.9% in February. The Governing Council judged data since its last meeting and concluded that it reinforced its expectation that asset purchases should conclude in the third quarter. Lagarde added that the growth outlook for the zone had increased substantially as a result of the war in Ukraine, but they will remain flexible and were gradual with any changes made. She also noted that the longer-term inflation risked moving above the target of 2%. Jumping the short hop over the channel back to here in the UK now, and we're facing similar issues with inflation and interest rate concerns. The Bank of England looks set for its first quadruple back-to-back interest rate hike, and no, that's not some Olympic gymnast move. I couldn't actually imagine Andrew Bailey would be able to do anything like that. City economists reckon that the central bank was now almost certain to raise rates again in May following their previous 3 hikes. The confidence in a rise from the city was strengthened by new jobs data showing a very tight market, with pay climbing and vacancies still running very hot. Declines in unemployment was due to a rise in inactivity as more older workers took early retirement or career breaks. Across the wider economy, sales in shops have slowed significantly here in the UK as households race to reduce the squeeze on budgets. According to the British Retail Consortium, retail sales for March rose by 3.1%, slipping from 6.7% in February, making it the lowest figure so far this year and a 0.4% drop compared with the same month last year. A spokesperson for the BRC reckoned that the rising cost of living and the ongoing war in Ukraine has shaken consumer confidence, and although sales are slightly higher than last year, it was probably due to increases in prices rather than people shopping anymore. Online fast fashion retailer ASOS has warned that Russian sanctions will cost the company millions of pounds as it battles with inflationary costs to run the business. The company expected to take a £14 million hit to its profits and reduce its growth prospects by 2% because of the sanctions. The forecast came as the company swung to a £15.8 million pre-tax loss in the 6 months to the end of February, compared with a £106.4 million profit a year earlier when it was among the internet retailers benefiting from the lockdown e-commerce boom as shoppers stocked up on leisure wear while stuck at home. Sales in the UK grew by 8% to £895 million over the period and by 11% in the US. However, ASOS said supply chain disruption had led to reduced availability of some products and had prevented it from selling some of its newest lines. ASOS also added that they were concerned that people would likely reduce their spending on fashion as the cost of living crisis cuts deeper in the UK. The company's share price is £14.50, down from over 70% from just 1 year ago. And now with all the headlines completed, let's head over to Fails of the Week, where I look at the story that's tickled my fancy. Just when you think it couldn't get any worse, Fails of the Week. Now, I don't know about you, but I have to spend a fortune on security when I leave my house and go to Aldi to get the weekly food shop. I'll often have at least 2 cars, one in front of me and one behind me, including an armed guard who keeps a lookout at the Greggs opposite. Hang on, this isn't me. This sounds a lot like the security detail that Mark Zuckerberg has to have. Sorry, I always get confused. According to Business Insider, the cost to keep the big man at Meta safe was an eye-watering $26.8 million last year, which included private jets and a full-time security detail for him and his family. These costs were up from the year before, when they faced an equally hefty $25 million. You see, even rich people have inflation problems too. Making up these costs is 24/7 bodyguard protection, as well as an office with bullet-resistant glass and a panic button. Since 2018, the cost to keep the Zuck safe have outstripped other big tech executives, although we have no idea what it really costs some of the other bigwigs to keep safe, like Amazon's Jeff Bezos, because they don't disclose those figures publicly. And now we're finally at your favourite section. Don't press the panic button just yet, but you can press the like button gently, as it does help out really small channels like mine massively. And now that it's nicely turned blue, let's head over to the best of the bets. Welcome to the best of the bets. The first meme of the week made me laugh, not at the meme itself, but at my own situation. Remember, if you just had your annual pay rise, you'll probably still lose money this year because inflation is too damn high. If only we got those stimmy checks that they got in the US. This next one really cuts though. I can't say I disagree. With lines on charts and weird names for patterns, you can basically just create your own thesis and pretend to look clever when in reality, you've got no more idea what's going to happen next than a monkey does. This next one's a good reminder that no matter how intelligent you are, or how good you are even at your own professional field, even the best find ways to lose money in the stock market. Even Isaac Newton himself FOMO'd into the stock market back in the 18th century during the South Sea bubble. If you've never heard of it, definitely Google it after this. Can you imagine if they had smartphones back then and the trading apps? It would have been chaos. For our last meme, a little video for you. A visual representation of the Federal Reserve trying to save the economy. J-Powell really is between a rock and a hard place. High inflation and a risk of recession if they hike rates too much. Just another day in the wonderful world of stock market and macroeconomics. And on that literal bombshell, thanks so much for watching. Please leave me a like if you've enjoyed the video and subscribe for many more. We'll be back at the same time next week, but until then, as always, happy investing.